If you have a lot of properties and the lender may like to see it better if it's broken out on partnership tax returns. If there's some different things reasons that you might want to do it just to separate everything amongst various tax returns. There's things like a pass-through entity tax credit that we could talk about or get into if that comes up. Hey everyone, Payton Gillis here of REI Tax University, where we talk all things tax planning for real estate investors. Today I want to talk about something that I see often and is frequently a problem. It's frequently done wrong. This is when spouses have a partnership for their rental properties. So you get an LLC, you've got some rental properties, and you decide that LLC is going to be owned 50-50 between husband and wife, 50-50 between spouses. Somehow it's going to be owned between the spouses. And what has happened in that case is you may very likely have created a partnership, and you may have created a compliance need for a partnership tax return to be filed. Now, what I often see is people come in and the prior accountant never filed a partnership tax return. They said, no, we just put this on the Schedule E on their personal tax return. We put their properties over there, and it's very likely wrong. Many times it's wrong. If you're in a common property state, which 41 of the 50 states are common property states, there's only 9 community property states, and Missouri that we live in, that's a common law state. Common law state, most times, if you have a spousal partnership, a spousal LLC, you need to file a partnership tax return, and consequences for not doing it, if the IRS gets a hold of it, can be huge. You can have late penalties. They can go to tens of thousands of dollars. So when they come into us, we typically get to be the bearer of bad news to tell them, hey, you set this up as a spousal partnership. I know they've never filed partnerships for you. We have to file a partnership on this. Otherwise, we aren't going to work with you because we could be subject to actual preparer penalties on this if we know about it and we did it wrong. So we are going to file a partnership for this if you want us to work with you. And we're going to charge you for a partnership business tax return, which, tends to take compliance fees up for people each year. And I don't love charging people fees for something that's not valuable to them. So I would prefer if we're doing this, it's because it's the right thing for them and they're paying us because we're doing something of value to them. So there are times where a spousal partnership can make sense. If the non-tax related reasons make sense, I've seen it for various reasons, but a lot of times it doesn't. A lot of times when they really understand it, when they talk with an attorney about it, there's no big difference. And that attorney's like, you could own this LLC just in one of the spouses' names. So let's say, there's 2 spouses, they have 10 properties, they have 2 different LLCs, both LLCs were owned 50-50. That's 2 partnership returns they have to do. If instead they come in, they set up one LLC, it holds 5 properties, it's in the husband's name, they set up the other LLC, it holds 5 properties, it's in the wife's name, both of those are 100% owned, they're legally protected, it's in the marital estate, and they can go directly on the personal tax return on a Schedule E, meaning we don't have to file an extra business tax return. It takes care of lowers the compliance fees a lot that we have to charge the client, and probably helps them from that standpoint. And if there's no non-tax reason to do it, they've probably put themselves in a better just overall fee standpoint for the year. Now, I want to note that I'm just talking about this from the tax, and I've noted that a little bit, but this is just from the tax side of things. So if you're talking with the attorney and there's a reason to put it into a partnership, if you have a lot of properties and the lender may like to see it better if it's broken out on partnership tax returns, if there's some different things reasons that you might want to do it just to separate everything amongst various tax returns. There's things like a pass-through entity tax credit that we could talk about or get into if that comes up. But just from a strict standpoint of what I usually see, spousal partnerships are usually done. A lot of times the compliance hasn't been done right and the spouses don't know what they don't know and they weren't advised properly to potentially set that up in one spouse's name if they wanted to. Guys, if you found this content useful or helpful, follow along, subscribe for more. Here at REI Tax University, we talk all things tax planning. So jump over to reitaxu.com if you want to consider being a member of the community. It is a paid membership. We have office hours, case studies, tons of resources out there that we're providing all the time. So again, jump over there. There's a monthly subscription to it and you can become a part of that community for the tax planning for you as a real estate investor to help you reduce your taxes this year and every year going forward by truly understanding and leveraging the power of your real estate for tax planning. Appreciate you guys tuning in.